We're half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching the China Show live at the Asian Financial Forum in Hong Kong. I'm Rebecca Choong Wilkins with David Ingles.
Good Monday morning to all our viewers just joining us across the Asia Pacific. Let's get to your top stories this Monday morning. Stocks across the region and emerging market currencies under immense pressure. As we get kick-started this new trading week, of course, it's after strong U.S. jobs numbers prompting a rethink on Fed rate cuts. Oil at a 4-month high after sweeping U.S. sanctions on Russia.
And China space, gloom continuing to grip Chinese stocks, the benchmark CSI 300 having its worst start to the year since 2016, and the MSCI China Index entering bear territory.
Also ahead, TikTok facing a U.S. shutdown next week. That's after the Supreme Court signals it's likely to uphold a divest or ban law.
Now we are at the AFF. It's really the first sort of big Hong Kong hosted financial forum of the year. Of course, such a big push that we've seen from Hong Kong to bring these kind of international finance events back to the city.
Yeah, in fact, we were just looking at some of the guests literally who are walking just right behind us into the stage where we are on the left, where we are starting to hear the perhaps the beginnings there, some keynote speeches. We understand, of course, there's a very important VIP that is on deck today. We'll get to see who that is. And of course, it's a jam-packed schedule as far as the conversations inside are concerned. We just finished a conversation with the Pakistan Minister of Finance and Revenue, and their outlook really on their market and the IMF talks, and a lot of conversations coming up here, of course, from the AFF. And maybe just to kick things off, I think we have China AMCs coming on at the top of sometime the next hour, plus, of course, our host really here.
Yes, and Christopher Hui will also be joining us. So a lot of details, hopefully, we hear. We, of course, have got the upcoming Hong Kong budget that's coming through. The theme here is growth. That is sort of the big theme of this conference. But of course, it's hard to ignore some of the headwinds that we've seen coming through that are pressuring Chinese stocks and Asian markets this morning.
I mean, one of the things, and it's quite timely that the strong jobs report that we talked about there, and the headwinds coming through out of a Fed that, by the way, it doesn't look like it's going to be able to cut, based on market conversations and pricing right now, more than 1, 2 at best cuts this year. And certainly here in Hong Kong, we simply import the higher rates from the Fed. So that's really one of the things we'll be talking with Christopher Hui about. Yeah. What are the potential offsets to these headwinds, including the tariffs that you mentioned there?
Property, a big one that's going to be of concern. And also some of these sort of tax breaks and potential, reforms around tax that might help ease the situation there.
Yeah. So stay tuned for those conversations coming up here out at the AFF. Really for a better sense of the damage we're seeing across risk assets this Monday, let's bring in Annabelle, who's looking at markets for us this hour. Belle, what are you seeing?
Yeah, well, Dave, Rebecca, really, it's all about the Fed. You were just saying there, we had that blowout US jobs report on Friday to end the weekend, and we're seeing really quite a sharp and market reaction to that off the back. So, again, it's that story around rate cuts and how many can we really expect over the course of 2025. Now we're down to just one, possibly, and coming toward the end of the year. Some are even saying perhaps the next move is a hike instead. And so that's really playing out in the session so far. We're MXAP ex-Japan this morning because Tokyo is shut today for a market holiday. But still, we do have futures trading. And again, we're setting up for further pressure here. Treasury futures as well. We're continuing to track those yields, are really referencing these changing dynamics around where central banks go next. So that is the state of play there. As you can see, truly a lot of red across the screen this morning. But let's take a look as well at one sector that is moving to the upside. And this is what you were saying there in the headlines. It's that story around energy, because we saw the US pushing through its most ambitious sanctions on Russian oil yet. And you are just seeing energy moving high. You've been tracking the moves in Brent crude, for instance. We've got energy stocks again. They're really one of the few exceptions in the green so far in the session. More details on that ahead. But lastly as well, you mentioned that we've got the MSCI China in bear market territory. Again, just taking a look at what we see for Chinese futures ahead of the open today. A little bit more pressure expected in the session. I was thinking, though, is it a sort of a story around, okay, New Year's gone, very bad start to the new year. What about Chinese New Year? And actually Goldman Sachs out with a call to saying 25% upside for Chinese equities over the course of this year, perhaps. So really one of the more optimistic ones we're hearing. But Dave, you've got some headlines dropping on the PBOC.
Yeah, just getting us warmed up. In fact, maybe a little bit too quickly out of bed today, out of the PBOC. Here we go. So we're already seeing some reaction in the markets. The offshore currency edging a tad stronger after this policy tweak out of the PBOC. This effectively means they're looking at capital, the capital curbs, if you want to be more specific about it. They've raised the cross-border macro adjustment parameter to 1.75. And are you seeing anything else, Rebecca, on your screen?
Yeah, so from 1.5 to 1.75, quite a big deal potentially. I mean, this is something that really has restrained some amount of liquidity.
Yeah.
It's a big sort of talking point as well, this debate whether or not we're going to see some of these things adjusted.
Well, we'll see. I mean, Mark, let me bring in Mark Cranfield out of our MLive team is joining us out of Singapore. Mark, we woke up this morning to that extremely surprising jobs report, the fallout from a tighter or more hawkish Fed playing out across these markets. Are you surprised to see the PBOC come out with something like this so early in the week, Mark?
Not really. The timing of PBOC decisions doesn't really correlate to what the rest of the world is doing. They're very focused on driving their own markets. They do have a big press conference with the SFAE tomorrow. So in that respect, yes, I guess people may be a little bit surprised that there's more information, but they're trying to pull as many levers as possible to try and raise confidence in the market. So we'll get these ad hoc moves from time to time. The big issue, though, is that you're talking there about improving liquidity. Well, they've been improving liquidity for some time, and that's obviously not what investors are waiting for. Investors can see that there's liquidity. What they want to see is interest rate cuts. And by delaying further the moves to lower, whether it's the repo rate or the minimum lending facility, that is what is frustrating investors at the time being. It sounded as if you go back a couple of months, it sounded as though the PBOC was ready to deliver another decent rate cut before the end of the year. That didn't arrive. You can see the equity market has been tailing back since then. And so, yes, there's already the liquidity, so let's get on with more rate cuts. That's what they want to hear tomorrow. That is what they're hoping to get out of the briefing tomorrow. They want to see that the PBOC is still committed to lowering interest rates. Now, the movements in the bond market, by the way that they've stopped buying bonds, it's only temporary, but again, is a disconnect. Investors are not happy by hearing things which are contradictory to the previous statements. So they really need to get their messaging very clear. They need to be consistent. They are wanting to support the market, and they're doing it in a uniform way. That is not what people are hearing right now.
Okay, Mark, talking about that clear and consistent messaging, talk to me about how this relates to the currency and the yuan, the type of support and intervention that we might see this week, and how investors are reacting to that.
Well, again, you can't have everything. You can't manage every single part of your economy and your financial marketplace. People know that. If you want to control the currency, which they're doing pretty well, they're keeping it in a tight range, it means that something else has to suffer. At the moment, it's the equity market, which is not very happy to see the fact that the yuan is being pulled down so much. Because part of that is they need to keep short-term interest rates higher than they need to. We've got this big issue of bills coming in Hong Kong to drain liquidity to try and keep the yuan a bit stronger. That is not effective if you're trying to boost sentiment in the equity market, and at the same time, you're trying to restrict moves in the bond market. You can't have everything at the same time. Eventually, when we see the policies that come from Donald Trump, the traders will be expecting the yuan to move lower. The PBOC will hold on as long as they possibly can, but they're really fighting against very big forces. The US dollar is so strong anyway. It's not just the yuan is in a position against the US dollar, which is also making it too strong against the euro and other currencies. So it's a very hard situation. Eventually something will have to give, and it will probably mean that dollar yuan has to go higher, but probably only after the Lunar New Year holidays.
Mark, we have some further headlines coming through here as it pertains to the Chinese macro policy. China holding this meeting for foreign exchange, for the forex markets in Beijing. The PBOC talking about how the exchange rate needs or will stay at a reasonable and balanced level. Mark, for very obvious reasons, risk assets are under immense pressure right now, following, to your point, the conversations around the Fed and rates markets on Friday. When do you expect dip buyers to come back in and perhaps provide some support to risk assets as we get started this week?
We might have to wait quite a while, particularly after these new sanctions that have been put on Russian oil, because if you look at the spike in oil prices this morning, that's not good for the equity market, it's not good for the bond market. The US dollar is already very strong, putting pressure on Asian currencies especially, and they're very exposed to imports. Some of the Asian countries have been importing a lot of oil from Russia, so if the cost of oil goes higher, that's going to weaken Asian currencies even further, at the same time as they're already suffering from higher bond yields in America and from a very strong US dollar. It's a very unpleasant and toxic mix for people in Asia especially. So until we see oil prices stabilise and the Fed getting into a position where they can lower interest rates again, there's big headwinds, especially for people in this region. And none of that looks as though it's going to resolve itself anytime soon.
That's Bloomberg MLive strategist Mark Cranfield there in Singapore joining us. And next, we are thinking more about this theme on Chinese stocks. Chinese stocks having their worst start to the year in nearly a decade, with that broader MSCI China index down more than 20% from its peak in October. Let's bring in Bloomberg senior equities reporter Abhishek Vishnoi in Singapore to help break this down. Abhishek, for the CSI 300 onshore, we're off to the worst start since 2016, I believe. That year ended 11%. What does this very gloomy and grim beginning for Chinese equities this year mean, and how are investors calibrating or maybe recalibrating their expectations for this year?
Well, it's not always a bad start, but clearly investors are shooting first and looking for asking any questions later. Market is clearly discounting tariffs and export curbs that can come from the US, and that's what is getting reflected in CSI's worst starts in 2016. MSCI China slipping into bear market just a week or 10 days before Donald Trump gets inaugurated as US president. So the markets are actually not waiting for Donald Trump to come in and actually make his first official move. They are discounting what he has said already and possibly pricing in the worst. Our reporting essentially is showing that, investors are not too enthused about the near-term future. At least for the first quarter, the returns are expected to remain muted, or maybe the CSI can even slip further from here. We did a survey of 15 strategists and fund managers who are investing in China. 10 of the 15 respondents said that in first quarter, Chinese government bonds and US dollar are actually better assets to own than onshore stocks. A lot of them also expect that any sort of incremental liquidity support that we are talking about. Yes, liquidity is coming in from central bank, it is coming in from government, but investor liquidity, that is not coming in, especially from foreign investors. The exodus is expected to continue from foreigners, and any incremental buying is largely likely to happen from state funds. So this is the macro backdrop. And if you drill down further, the survey actually points out that corporate earnings, which are the most important aspect for any equity markets in the long term to deliver, are actually going to improve only in the second quarter. So you have one more quarter of gloomy earnings, and the domestic problems are just there. Consumer consumption is still weak, deflation is still there, property is not getting as much support as it like to. So the outlook is a bit grim as far as the first quarter is concerned.
Abhishek, okay, I think we've inundated our viewers with enough bad news. 30 minutes into the session and into the show already, a lot of negative news. Let's brighten the mood. Belle, I'll bring you in. Annabelle Droulers, of course, who's standing by for us in our Hong Kong studios to talk us through the... Belle, you mentioned this earlier on, the silver lining to a market that has entered a bear market are these sell-side calls from the likes of Goldman calling for a rebound. Break that down for us, Belle.
Yeah, that's right. I mean, I'll give a bit of cheer to start us off on the week, but Goldman Sachs is out with a call this morning, and they're saying that actually over the course of 2025, maybe we see something to the tune of 20% upside. I think that they already referenced a lot of those factors that Abhishek just mentioned there around sort of the outlook, the amount of uncertainty as well, risk of tariffs. They're saying that basically all of that's been factored in, and from this point on, they're actually seeing gains. They're saying that the sentiment The liquidity backdrop that Abhishek mentioned as well, they're actually expecting that to improve toward late first quarter of this year. They're also expecting better tariff, better policy clarity as well, because of course we're looking ahead to the MPC in March. And so they're recommending that to buy the government consumption proxies, EM market exporters. It's going to benefit from yuan depreciation. They're looking at also select tech infrastructure names as well. So they're saying that, you know, we do have a bit of reason to be a little bit more optimistic, perhaps.
Annabelle, thank you so much. Annabelle in our Hong Kong studios and also out of Singapore, Abhishek Vishnoy, talking you through the outlook and the reality of these Chinese markets as we get started this week. The reference rate of the day is out of the PBOC, 7.1885 against the US dollar. This is following a couple of hot headlines coming through out of China. For one, the PBOC, and you might have seen that, the currency will remain at a reasonable and balanced level. To get us started for the week, of course, those are the parameters as we look ahead to the open 15 minutes away. Coming up here on the China Show, we'll head back to Shanghai and why the head of China and global markets there for UBS, Thomas Fang, anticipates further gyrations in this market ahead of the Lunar New Year. He joins us later for an in-depth discussion on the stimulus efforts and also what's in store for the country's equity market.
Yes, and elsewhere. First, the clock is ticking for TikTok in the US after the Supreme Court indicated it's likely to uphold a ban. Eurasia Group joins us next to discuss the full implications of all of that. And we are counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. This is the China Show. Stay with us.
Yep, the clock is ticking on TikTok here. That's after the U.S. Supreme Court signaled it is likely to uphold this law that would ban the platform. That's if it's not sold. Okay, bit of a tongue twister here. By its Chinese parent company ByteDance by the 19th of this month. That's in 6 days from now. So a majority of justices suggested in Friday's hearing that national security concerns could outweigh free speech interests. Belle, more on the story.
Yeah, that's right. I mean, it's sort of the arguments that we heard on Friday in the court. But let's get more on those now. Bring in Xiaoming Liu, Director of Geotechnology at Eurasia Group. And Xiaoming, let's start off with your reaction to this case. Because, again, as I said, it sort of was those similar arguments we'd heard in the past. But what stood out to you in particular?
I think after the legal argument, I think my biggest change of assessment is that previously there's a chance of delayed ban. I think Trump's team has filed a legal brief requesting for that, and TikTok has also proposed that scenario. But during this legal argument, that issue didn't barely come up. So now my probability for the delayed scenario to happen is much lower than before.
Yeah, and so that really gives us a very tight window or tight deadline here. What do you think then is the most likely scenario? Because TikTok's making the case that it's extremely difficult to divest its app.
Yeah, that's very challenging situation indeed. I think technically there's still a legal route to do this. Let's say if Trump leveraged the letter of the law that says the president has a big say in determining what constitutes a qualified divestiture. So if Trump say Zhang Yimei selling some shares to Jeff Yass or other non-Chinese buyers reach that threshold, potentially there's a way to interpret the law that way for Trump to facilitate a deal together. But looking at this case in the reality of Washington's politics, if that were to happen, I would see Congress and even the public viewing that type of act as a violation of the spirit of the law, maybe not the letter of the law, but the spirit of it, and calling Trump being soft on China. That's a lot of political pressure for the president to handle.
Yeah, and we know that Trump has sort of flip-flopped in his assessment of exactly what should happen here, and he's now sort of more in favour of TikTok. But you know, how much in favour is he really, and what's in it for him to force it to divest or to sell or to keep it?
Yeah, I I believe Trump fundamentally doesn't really care about the platform. Remember, the first time around, he was the one that tried to ban the platform operating in the US. I think right now he's just doing some favor, channeling the voice of some US investors that has been pushing for the deal for a long time. But in reality, I don't think he really think this is a big issue for him. This is not the hill that he's going to die on.
The one side that we haven't spoken too much about really is how China reacts to this, because we know that Beijing has the ability to block any sale as well. How exactly would you expect them to respond?
That's another layer of the difficulty of this deal. I think last time around, China said they don't want a fair sale of TikTok's algorithm. I think right now they're still holding this view. Even they're being quiet. They're not voicing any concern yet. But I think if push come to shove, they don't want that scenario to happen. And if Trump really want to push through, he needs to strike some sort of grand bargain with Beijing. And that's a tall order as well.
So do you think then there's the chance that TikTok actually just ends up becoming sort of a bargaining chip in any sort of negotiations?
I think there is a chance of that. But I don't know if we'll come to that point, given this is not a huge priority for Trump. This is honestly not a huge priority for Beijing right now. Trump won a lot of tariff on China, and Chinese government want to strike a bargain with the president if they can. I think if you're looking at what could be in that package for the US and China to agree on, TikTok is a very small chip in that whole package.
So what do you think then is the most likely scenario? Do you really think it is that TikTok ends up being banned in the US and it goes so-called dark and people can't use it, can't access the updates? Do you actually see that as being what happens next?
Yeah, I think that's my base case. I think the app will go unusable for users in the US, because once the app is being suspended, app stores, cloud internet service providers will cease their operating support to the platform. Existing users can still access it through VPNs, but future updates and patches can't come through. Eventually, that will make the program hard to operate.
There is another app that we're hearing that users of TikTok in the US are gravitating toward, and I don't know how closely you track Lemonade, but this is also owned by ByteDance. Do you think that any sort of ban will be applied to TikTok only, or do you see other sort of potential winners out of this TikTok ban also being affected if they are owned by ByteDance?
I think if this popular social media app got shut down, the primary winner will be its US competitors, Google Ads and Meta and even Etsy, that type of platform. They will gain traction. Even a lot of the fans that Trump has on TikTok, they can migrate to other social media platforms. Even Meta, which recently changed its position to be more free speech in their content moderating policy. I think that's an area where Trump can regain his fans.
Thanks so much for your time. That was Xiaomeng Lu there, Director of Geotechnology at Eurasia Group. And we're about 5 minutes out from the open of Chinese equities this morning, as we've been discussing so many bearish signals facing these markets as well. We've got the HSI, for instance, in early trading dropping below that key 19,000 mark. But taking a look at how other parts of the market are trading as well, and you can see here just a picture of red across the screen, also tracking really what has been the broader trading sentiment in Asia, given you've got these changing expectations around the Fed and its ability to cut this year. But let's also take a look at analyst actions as well. That's to note in the session. The big one we're tracking is one from JP Morgan, and they've actually cut a lot of price targets for different appliance makers. That's an interesting move because we have seen that sort of run up off the back of that trade-in program that was initiated toward the end of 2024 and has been expanded to other consumer electronics this year. So not a good outlook there. But also some of the stocks that we're tracking this morning, and we've got airline ones to watch. We've seen Delta posting an earnings beat, rather. So far not seeing too much movement, but mainly to the downside there. Consumption stocks as well to note, because we have seen that push again from Beijing to boost spending. So we'll be tracking those as well. But you are watching the China Show. We're going to have the open just after this, ahead of the break. This is Bloomberg.
Welcome back. You're watching the China Show. We're counting down to the open of markets live from the AFF in Hong Kong. A lot of excitement, potentially this VIP guest that we're waiting here, David, but really all eyes on markets this morning. It's getting pretty ugly.
It is, and it didn't really take a lot of time for us to get to these levels. I mean, are we surprised that the Hang Seng Index is trading below 19,000 for the first time? I mean, it was almost a slow grind here. Last week was quite terrible, of course, as the start to the year. Something we were mentioning earlier on, we did enter a bear market. I believe some of our producers are letting us know here that we are about 3-4% away, get this, right, from reversing all of the post-stimulus gains. So we've come a long way down, and maybe 1 or 2 bad days away from that. Hopefully for the bulls that doesn't happen. And we're looking at, of course, what we could see as far as the open today. And Belle, of course, is standing by with in our Hong Kong studios for a look, Belle, at the early damage across these equity markets.
Yeah, and it is damaging. I mean, that's the only really way to say it this morning. It's been that story. Not only are we having a shocking start to the year for Chinese equities, as we've been saying, and we're really just waiting for any sort of further clarity that we get. We've got Donald Trump back in the White House in just a few days from now. What's he going to be doing around tariffs? Economic malaise within China. We haven't really seen consumption being boosted. You've still got issues in the property market. So they're all the issues that we already know about. You add to it as well the story for the Fed, because on Friday we had that very strong jobs report, and it's really leading to that repricing once again. Treasuries back at 5%, for instance. What does that mean for equities in turn? What does that mean for the dollar? And these are headwinds that face these markets. So you're seeing the CSI 300 coming on this morning, 0.6% to the downside, but broader losses here. Quechamoto, for instance, CATL down 1.3%. That is it there. Medea, of course, to track off 1%. We actually had that analyst downgrade to a lot of consumer electronics from JP Morgan. Even as we've been saying, the trading program has been expanded. But let's take a look at Hong Kong in particular. This is a market that really feels, especially given you do have the monetary authority following the Fed, very exposed to what is happening in the US economy, also what's happening in China. And this is really where we see that playing out. Tech losses, for instance, you're seeing Alibaba, Tencent, Alibaba off more than 2% at this point. Meituan, I mean, stocks are just really feeling the pain of this. And as we've been saying, the big headline today, if you take a look at this terminal chart, is the MSCI China entering bear market territory. Should just note, actually, as you said, the Hang Seng below 19,000, but bear market territory. Again, technicals are saying that we're oversold at this point in time, but really, what is there to tempt investors back in when you've got other markets that look more promising? And of course, the chief one among those is the US.
Yeah, I mean, a point that I think not a lot of people have been talking about is, we've been looking at the Chinese side of the equation and figuring out whether they've done enough. The Minister of Finance, the PBOC, there's a briefing, of course, tomorrow. While that they may not have done enough, the other side of the equation, U.S. exceptionalism, has certainly provided an additional headwind for these markets. We understand, and the main stage of the AFF is taking place right now, and we now know who that VIP guest is. Let's listen in and have a look at the PBOC governor here in town.
Pickup of the economy. On the whole, the Chinese economy has managed to address a variety of risks and challenges in recent years and proved to be strongly resilient. It has contributed approximately 30% to the global economic growth for years. Currently, given the complex and ever-changing external environment, challenges remain in China's economic development. Externally, as the world pattern is becoming increasingly chaotic and intertwined, Geopolitical conflicts continue, and trade protectionism prevails. Challenges and uncertainties loom over global economic recovery, exerting a spillover effect on the Chinese economy. Internally, we still face problems such as insufficient domestic demand, especially consumption demand, weak social expectations, low price levels, and so on. The Chinese economy is blessed with powerful innovation capability, super large markets, complete industrial system, sophisticated infrastructure, and abundant high-quality human resources. We have confidence, capability, and means to overcome difficulties, resolve challenges, and achieve sustained growth. In 2025, China is expected to continuously inject strong growth momentum and stable force to the world. China will respond to the expectations of the global community with responsibility and courage, and it will continue to play its important role as the engine of the world economy. Not long ago, the Central Economic Work Conference was convened. It made clear the target, macro policies, and key tasks for the economic work in 2025. We will implement more proactive macroeconomic policies and further improve the economic governance approach. The first is to strengthen counter-cyclical adjustments in macroeconomic policies, tune the trajectory of economic growth and functioning so as to maintain stable economic growth. We'll implement more proactive fiscal policies, raise fiscal deficit ratio, expand fiscal expenditure, and adjust and improve structure and distribution of fiscal expenditure. We'll also implement an appropriately accommodative monetary policy, adopt a mix of monetary policy instruments, including interest rates and required reserve ratio to keep adequate liquidity and favorable social financing environment. The second is to proactively promote transition of China's economic growth model to enhance quality and sustainability of economic growth. It was made clear at the Central Economic Work Conference that we should focus on boosting domestic demand, especially consumption demand of residents, and vigorously boosting consumption would be the top priority of the economic work for this year. Priority of macroeconomic policies should shift from promoting more investment in the past to promoting both consumption and investment, with more importance attached to consumption. By increasing residents' income, enhancing consumption subsidy support, innovating consumption supply, and improving social security will effectively expand consumption, give better play to the role of consumption in driving up economic growth, and promote high-quality development of the Chinese economy. We will improve our approach to economic governances on an ongoing basis. We will handle relations between the government and the market in a better way, scientifically balance their boundaries, and respect and leverage the decisive role of the market in resource allocation. We will speed up building of a unified national market, foster a sound law-based economic environment, and create a more fair and vital market environment. The third is to focus on addressing risk in economic functioning. The Chinese government has taken a series of policies to effectively mitigate risk related to local government debt and the real estate market. Up to now, these risks are contracting on the whole. In terms of local government debt, the Chinese government debt level is in the middle to low range internationally. The debt burden on the central government is not heavy, while the debt risks of the local governments are mainly concentrated in some less developed regions. In recent years, we have taken a series of measures to enforce strict financial discipline and control new debts. We have guided financial institutions to, following the market principle and the rule of law, consult on an equal footing with financing vehicles and restructure their debts through rollover, paying off old debts with new loans and debt swap. The aim is to gradually transform those financing vehicles into market-oriented enterprises. Up to now, the number of local government financing vehicles and their debt scale have both plunged, indicating a contraction of risks. To further define risk related to local government debt, the CPC Central Committee has decided to raise the debt ceiling of local government by 6 trillion RMB. and allocate 4 trillion RMB in the newly issued local government special bond to swap the existing implicit debts. The two combined will provide funds worth of 10 trillion RMB, which will significantly reduce the pressure for local government to defuse debts and mitigate the debt risk of local financing vehicles. In terms of the real estate market, after long cycle prosperity for nearly 3 decades, China's real estate market has experienced a fundamental shift and is now looking for a new point of equilibrium. We implemented a mix of policies from both demand and supply sides, such as removing restrictions on housing purchase in medium and large-sized cities, optimizing real estate financial policies, lowering down payment ratio and mortgage rates, and establishing a financing coordination mechanism and improving relevant tax policies. Meanwhile, the business entities worked hard to heal and improve themselves by adjusting operation strategies and restructuring their debts. With these efforts, the risk of the real estate market have been greatly mitigated and the transactions increased overall. Since October 2024, floor area of for-profit housing sold in 30 medium and large-sized cities has grown for 3 consecutive months on a month-on-month basis and for 2 straight months on a year-on-year basis. CPC Central Committee has made it clear that local government special bonds are allowed to be used for idle existing land buyback, new land acquisition and reserve, and for profit housing purchasing. This will further accelerate destocking of the real estate market and enable the real estate market to stop declining and stabilize. The fourth is to lay emphasis on the internal and external equilibria in the economic growth. In recent years, external equilibrium of the Chinese economy has been effectively improved. The current account surplus to GDP ratio dropped from around 10% in 2007 to around 2% in 2011 and remains within the range of 1 to 2% in recent years, which is generally considered as reasonable by the international community. The current geopolitical tensions has led to economic deglobalization as well as politicalization and instrumentalization of international trade, which hampers sustained growth of the world economy and the increase in global welfare. We'll firmly follow the path of reform and opening up and the path of multilateralism, advocate free trade and fair competition, and make better use of both international and domestic markets and resources so as to accelerate building of a new development paradigm. Recently, the USD index has remained high and most non-USD currencies have depreciated. RMB has also depreciated moderately against USD, but overall shows strong resilience. After years of endeavor, China's foreign exchange market has achieved remarkable development. Market participants are more mature and the trading activities are more rational. The RMB cross-border payments and receipts have reached 30% in goods trade, lowering the exchange risk exposure faced by enterprises in production and operation. As regulators of the foreign exchange market, the PBOC and State Administration of Foreign Exchange are now more composed and experienced in the face of market changes. We are confident and capable of maintaining stable functioning of the foreign exchange market. We will pursue the principle of letting the market play a decisive role in exchange rate formation and leverage the role of exchange rate as an octo stabilizer in macroeconomic management and for balance of payments. Meanwhile, we will firmly correct pro-cyclical behaviors, fight against conduct that disrupts market order, and prevents the risk of exchange rate overshooting so as to keep RMB exchange rate basically stable at an adaptive and equilibrium level. Second, about deepening financial cooperation between the Chinese mainland and Hong Kong. Hong Kong is a major international financial center, boasting a highly open business environment, a developed financial market system, sophisticated financial infrastructure, enormous human resources advantages, a sound legal system, and an internationalized financial regulation system. In November, Vice Premier He Fang explicitly pointed out in Hong Kong that effectively building, strengthening, and developing Hong Kong as an international financial center is not only what Hong Kong needs but also what matters to our country. In recent years, PBOC, together with other relevant authorities and departments, has promoted implementation of a series of practical measures, including Bond Connect, Shanghai Hong Kong Stock Connect, Shenzhen Hong Kong Stock Connect, Cross-Boundary Wealth Management Connect, Swap Connect, and signing currency swap agreement with Hong Kong MA to bolster development of the offshore RMB market in Hong Kong, which has achieved remarkable progress. The efforts injected new momentum into the development of Hong Kong as an international financial center. In 2024, financial markets in Hong Kong witnessed more brisk activities, with RMB deposits, loans, dim sum bond issuance, and foreign exchange trading maintaining good momentum. Going forward, we'll continue to extend full support to develop Hong Kong as an IFC, with our efforts focused on 4 areas. First, we'll support development of the capital market in Hong Kong and deepen connectivity between the financial markets in Hong Kong and the mainland. A thriving capital market serves as the core and backbone of Hong Kong as an IFC. By coordinating and cooperating with financial regulatory authorities in Hong Kong, we will explore to expand the role of central bank in macro-prudential management and financial stability, which will support healthy development of capital markets in both mainland and Hong Kong. We'll encourage quality enterprises to get listed and issue bonds in Hong Kong and expand connectivity mechanisms between the mainland and Hong Kong for stocks, bonds, wealth management products, and interest rate swap. Also, we'll deepen the financial cooperation within the Guangdong-Hong Kong-Macau GBA and increase allocation of China's foreign exchange reserves in assets in Hong Kong so that the financial development in Hong Kong will embrace a broader future. Secondly, we'll expand and strengthen the status of Hong Kong as the hub of offshore RMB business. Hong Kong is an offshore RMB business center with the largest business volume in the world. Giving play to the role of RMB clearing banks and currency swap arrangements in a coordinated way, we have signed a 800 billion yuan currency swap agreement with the HKMA. We will support Hong Kong MA in supplementing RMB liquidity on the offshore market by drawing on the swap line, issue RMB government bonds, central bank bills in Hong Kong on a regular basis, and enrich the products and services provided on the offshore RMB market in Hong Kong. PBOC and Hong Kong MA have set up a special working group committed to the study and design of relevant policies and products. Thirdly, strengthening Hong Kong's function as an international asset management and wealth management center. Hong Kong is the largest global asset management center and private wealth management center in Asia. We will further optimize the Cross-Boundary Wealth Management Connect and QDII scheme and solidly implement mutual recognition of funds enhancements to better meet the needs of residents in both the mainland and Hong Kong for cross-market and diversified asset allocation. We'll attract more inflow of funds from the mainland and the world to Hong Kong and continuously enrich diversity of financial businesses in Hong Kong, such as PE, venture capital, private bank, family office, and hedge fund, thereby amplifying Hong Kong's influence in global asset and wealth management markets. Fourth, resolutely safeguarding Hong Kong's financial stability and security. Over the years, with the strong support from the country, Hong Kong has successfully navigated multiple financial crises and external shocks, maintaining overall resilience in its financial system and accumulating extensive experience in preventing and diffusing major risks. At the crucial moment in 1998, when Hong Kong was struggling with the impact of Asian financial crisis, Mr. Zhu Rongji, the then Premier, declared to the whole world that the central government will resolutely safeguard the prosperity and stability of Hong Kong. Today, China is even more robust in its financial strength, with the size of foreign exchange reserves ranking safely at the top of the world, which will surely provide strong backing for the financial stability and safety of Hong Kong. Recently, PBOC is in close communication with Hong Kong MA and the securities regulators of both sides. Relevant policy measures will be introduced in 3 key areas, namely enhancing development of offshore RMB market, optimizing financial market connectivity, and improving payments and settlement convenience. in terms of enhancing development of the offshore RMB market. Firstly, supporting Hong Kong MA in launching RMB trade financing liquidity arrangements. On the basis of the existing framework of RMB liquidity arrangements, the swap line will be used to launch new RMB trade financing liquidity arrangements with terms of 1 month, 3 months and 6 months, with total quota of 100 billion RMB, aiming to provide a stable and cost-effective source of funding for RMB trade financing of commercial banks in Hong Kong. Second, supporting the launch of offshore bond repo transactions under the Bond Connect. The measure will enrich liquidity arrangement management tools for investors and enhance the appeal of RMB-denominated bond assets. Additionally, cross-border bond repos transactions will also be introduced at an opportune time. Thirdly, actively supporting the launch of offshore RMB government bond futures in Hong Kong. The measure will play a significant role in consolidating and enhancing Hong Kong's status as an international financial center, a global risk management center, and an offshore RMB business hub. Regulatory authorities from both sides are working in close coordination to advance preparatory work in an orderly manner. In terms of improving mutual access between financial markets, first, we'll support the use of bonds under Bond Connect as qualified collateral in financial markets in Hong Kong. Previously, we announced to support overseas institutions in using bonds held under Bond Connect as margin collateral for Swap Connect transactions. This arrangement will come into effect today. Moving forward, we'll support a wider use of bonds held under Bond Connect as qualified collateral in financial markets in Hong Kong. Secondly, we'll improve operation mechanism for southbound trading under Bond Connect. Domestic investors will be supported in buying bonds denominated in various currencies more conveniently, and settlement hours will be extended. Moving forward, we'll expand the coverage of investors in an orderly manner and increase custodians. In terms of facilitating payments and settlements, we'll accelerate cross-border interlinkage of fast payment systems. We'll promote interlinkage between fast payment system of the Chinese mainland and that of Hong Kong, which will support residents of the two places in real-time cross-border remittance,
thus providing safer, more efficient and more convenient cross-border payment services for economic and trading activities and personnel exchanges between the two sides. Also, we will further expand the list of participating banks offering residents of Hong Kong and Macau agency account opening witness services. Thanks to Hong Kong's unique advantages and its industrial residents, we believe its status as an international financial center will continue to be consolidated and strengthened. Last but not least, financial leaders around the world are welcome to invest in China's financial market, sharing together with us the development opportunity. I wish this forum a complete success. Thank you.
For that insightful address. Thank you for speaking to us today. Last but not least, I'd like to invite Mr. Liu.
Really interesting to see Gongsheng here, particularly speaking to an international audience. Some of the emphasis here on the challenges that the Chinese economy is facing, the issue with consumption, for example. Something that did catch my eye is this repetition. I think we heard it back in 2023 possibly, but this shift, this need to shift from investment to consumption. It really has been the big story, particularly when we think about 2025.
Yeah, and that's a good point because easier said than done. They solved the consumption problem, which is really that build up in excess savings at the banks, the property market. They solved most of the problems in this economy. Give us some context. You've attended some of the events and engagement of Gongsheng.
Yeah.
He's very well liked in the industry.
Yeah, very interesting to see Pan at an event like this. I mean, you will tend to see him chatting with bankers, chatting with delegates afterwards. I've seen him sort of swapping jokes with people, for example. He's pretty approachable and he's quite popular, I would say, in kind of Hong Kong bankers. They do like to see him. He's seen as someone, I think, that you can sort of have a real conversation with, a little bit of back and forth with. And Beijing has sent him, over the last sort of years, months, like to come and talk about these sort supportive events to try and speak specifically to an international audience. No, he's just been speaking with the governor for the UK, for the central bank in England. He's also speaking to some of the heads of banks, international banks, as part of that visit from UK Cabinet Minister Rachel Reeves to Beijing. So he's sort of been rolled out here to speak to a number of different sort of international visitors and audiences.
I mean, he is the face of macroeconomic policy in China, really. And when you look at the market impact based on which ministry and which department is speaking, you really see the most market impact. At least the markets tend to listen to Pan Gongsheng the most, and for obvious reasons. He is the governor of the PBOC. Well, we'll keep a seat warmer here just in case he decides to suddenly join us right now.
Well, he was a surprise guest. Anyway, keeping on track of other guests at other conferences, we're across the mall here on the China Show this morning. The UBS Greater China Conference, it's underway in Shanghai, and our chief North Asia correspondent, Stephen Engel, is there with our very next guest.
Yeah, that's right. We're sitting here and been watching, of course, Pan Gongsheng give that speech in Hong Kong. But we're here at the UBS Greater China Conference, the 25th anniversary of that significant conference here in Shanghai that's been held for more than 2 decades. And the host every year, of course, is Thomas Fang, UBS head of China Global Markets. We've been sitting here listening to Pan Gongsheng. He's saying all the right things about supporting the economy, going to keep the yuan fairly stable, but at the same time, their priority must be boosting consumption. These are things you want to hear. Is there policy fatigue, though?
Well, Steve, first and foremost, you are welcome to our event, our conference. Yes, so by looking at it, I think Governor Pan is very well received by our international investor base. So by him speaking, hopefully it will help the market in some ways. But overall, our global investor really want to see concrete measures, and especially on the physical front. So on the monetary part, there are so many things has already been taking place, but it's the combination of the policy and the implementation of those policies is what our global clients are looking for.
So what do the market sell-off in China really telling you about the strength of the economy? The market's not the economy, but there's so many factors at play here. Persistent deflation, lack of consumption. What the Fed possibly might do or might not do, obviously, is roiling global markets right now with a strong jobs report. What do you think is going to be the catalyst to get Chinese equities turned around? They're into a bear market right now with the MXCN, the China Morgan Stanley index, down 20%.
Well, a couple of things, right? So I think in some way, the current, the first week of the year came with a pretty soft start, right? But that's on a combination of, year-end de-risk. Also, China came off on one of the best performing year over the past 4 years. So that's one part of it. But overall, I would say the valuation and then the overall global investor continue to look at diversification under the current environment. And also, hopefully, with some of the catalysts on the policy front, will bring China back up.
So what are you recommending to clients? Obviously, we've seen a stampede into CGBs, government bonds with benchmark yields tumbling to record lows. That's really sapped some liquidity into the stock market.
Well, so there's a bit of a rotation, but at the same time, so those rates environment in China will also help overall the economy and also the funding environment. What we have focused on in terms of investment thesis, one is, for Q1, before the 2 sessions, probably client would stay on the more defensive side, high dividend, high quality names. And also looking a little bit longer term, we're still looking at recommending, high quality internet companies, some of the tech company which will benefit from the self-reliance theme for China, and also some of the staple consumption play.
So Liang Hui, the 2 sessions, the National People's Congress and the CPPCC is going to be held in the first week of March over the course of 10 days. Do you firmly expect policy to come out in support of the economy and markets?
Well, Steve, so I coined this whatever it takes moment since end of September. So I still a firm belief. So the Chinese policymaker, it will take them some time to figure out the whole mechanism and how to communicate to the market. But the determination from Beijing are very, very clear. But our suggestion to the Chinese government is really, you may not have to wait until a certain point of time. Just to make sure you roll out the policy as much as possible and also as early as possible.
Well, they've been reluctant to give the so-called big bang, big yuan number, big dollar figure on stimulus. I mean, is that something that they're avoiding to do because of the debt loads at the municipal and local government level? Pang Gongsheng just talked about they think they found some stability in the finances of the local governments.
Well, it's a combination. I think, our global investors wanted to have a big bang, right? So whether it's 20 trillion or what have you. But overall, the system works from multiple regulatory bodies. It's not just one particular policymaker to make that trigger. So it takes a little bit of time. And also for this government, with this kind of scale of the challenges they are facing, it also would need some of the time to implement those. We have already seen some of the local government vehicles being released, and then also on the consumption side, there are trading policies, but they will take a little bit of time for the real economy to really feel the numbers and the improvement.
Now, foreign investors keep pulling money out. In December, we saw passive funds pulling about $1.1 billion out, active funds seeing about $2.4 billion of outflows. How do you stem that fall, and what do you tell your international clients here who are thinking about risk mitigation?
Well, I would say, some of the outflow we have seen is also on the back of a very, very strong rally, right, since September, doing a bit of a risk adjustment towards the end of the year and the beginning of the year, especially before the inauguration next week. It makes sense, right, from a risk point of view. But overall, as you can see, so there are more than 3,000 participants in our conference. Every investor really care about how to invest into China from the bottom-up approach and also the top-down approach. So we're looking forward to getting some of the answers and address the uncertainties here.
A lot of Chinese investors here as well. What are you telling them? What's your messaging on how to navigate the incoming Trump administration and the threat of tariffs and a possible protectionist trade war?
Sure. We have many experts from many angles discussing the details. But overall, so I take a relatively constructive view. So Trump 2.0, with the experience from the first administration from him. So hopefully Beijing get to know what are the transactional Trump administration will be. And at the same time, it will, in my view, reduce that potential military risk from all the narrative he's pushing, which would be good for the risk perspective.
What do your geopolitical fear gauges tell you about pricing of that risk? Is it pretty much already priced in? Because we have the certainty that the Trump administration will be coming in next week. We have somewhat certainty that tariffs will be part of his day one agenda. Is that priced in, or is there more pain potentially from the geopolitical front and the Trump policy agenda?
Yeah. From our analysts' analysis, so normally if there's anything to be announced after the inauguration, market will normally continue to react in the shorter term and then bounce back. So those are the things our investors are preparing for. But overall, we are hopeful, right? So it would not be as volatile as the first term.
Yeah, that's right. Deflation is persistent. Look at the CPI. It's just barely above 0.1% in December. PPI, 27 consecutive months of factory gate deflation. What is needed to turn that tide, and that will help corporate profitability, which will then feed back into a recovery?
So two major advice we've been giving to the policymaker. First is really focusing on not necessarily stimulating on the investment side, or manufacturing, but it's really on the demand and the consumption side. Really, that's really what potentially drive that price action. And the second is really on the confidence from the entrepreneur and also the confidence from the private sector and the consumer. That's a combination of policy clarity and transparency, and also really getting the numbers in to have that positive feedback through, whether it's property price or stock market price.
Yeah, well, do you believe what Pang Gongsheng says? He believed that the stability is now in place, essentially in the property market, but it still remains a tremendous drag on confidence and spending.
well, it takes a little bit of time for such a big economy facing both structural and also some of the cyclical issues, right? It takes time, and I'm a believer, so China will bounce back, and we're hopeful for 2025.
As Pan Gongsheng says, China is still an engine of global growth.
Agreed.
All right. Tommy Fang, thanks so much, UBS, Head of China Global Markets. Thanks for having us again in person.
Yes,
it's great.
great.
Yeah, good to see it. We'll send it back to you guys.
All right, yep, we are all over this Chinese market story. Stephen Engel, of course, in Shanghai for us there with Tommy Fang, Head of China Global Markets at UBS. Back here, really, and the big event so far, the AFF, was the surprise appearance in that speech coming out of the PBOC governor, Pan Gongsheng, of course, just wrapping up his speech a couple of minutes back. We also have some trade numbers coming through, which we'll get to in a moment there, but we can certainly, I guess it's safe to say, eco-numbers, backward-looking eco-numbers are sort of taking a bit of a backseat today. A lot of conversations are coming up in Shanghai and here where we are separately in Hong Kong. So the Fed conversation, no, we haven't forgotten about that. There we go. The former Fed Vice Chair will be joining us at those times on your screens this hour, joining us exclusively to talk us through the path of rates as we try and figure out whether or not the Fed can in fact cut interest rates this year. On the back of that as well, we are looking at this market on the back of the Fed, Bell, that sort of can't catch a break, really, Bell. What are you seeing as far as markets go?
Catch a break because we're waiting for it to even start to think about cutting, which we're hearing could be, or thinking could be, maybe toward the end of this year. Some are even saying it could be a hike off the back of those stronger than expected jobs figures. But the markets today are very much reacting to what we just heard from Governor Pan there, speaking at the AFF, where you are, of course, this morning for us. But we have seen the CSI 300, for instance, trading fairly steady right now, but at least it has lifted off the lows of the days. I'll let you get through all the details of that, but just safe to say at a headline level, they're looking to use a range of different policy tools to try and keep liquidity ample. Hang Seng, though, really still feeling the brunt of that, and you do have to think, well, that is partly, as we said, the Fed story that plays into this, given that Hong Kong really feels the brunt of those two twin factors, what's happening in the US and what's happening in China as well. So we're tracking that very closely. Dollar yen as well, or yuan rather, to note, given we did see that very strong pushback from the PBOC in the fixing. How long that lasts, though, of course, that's another thing to be watching as well. But Dave, certainly the headlight this morning as we await those trade figures is what we heard just in the last half hour or so.
Absolutely. It's what we in the TV business call inserting itself into the rundowns and tossing most of what we've planned so far out the window, but such is live news.
Yeah, but really interesting comments from Pan coming through, and interesting that they're choosing to send him to speak to an international audience right now, talking about this priority shift in policy to investment and consumption, also talking through some of the sort of headwinds that the Chinese economy is facing, quite frank remarks there, emphasizing again this willingness to use interest rates, the triple R, to keep liquidity ample, and then talking about some of the risk mitigations. We've seen a lot of work on LGFEs, of course, the real estate crisis, this phrase that has been coming up a bit more recently about finding a new equilibrium in the real estate market. It's sort of euphemistic, but basically this question, are we going to find a bottom? Perhaps it's sort of somewhat of a promise that we are maybe going to start seeing that in 2025.
Yeah, sorry, you might have just caught me there off air. We are a bit acting as a bit of a magnet here for some
Aren't you always,
onlookers.
Dave?
I think they were taking a picture of you just there as well. But I think, to Rebecca's point, the acknowledgement that China has done a lot to mitigate the tail risk, but much more needs to be done as it pertains to bolstering domestic demand. In fact, just have a listen specifically to what the PBOC governor had to say about consumption and efforts there.
It was made clear at the Central Economic Work Conference that we should focus on boosting domestic demand, especially consumption demand of residents, and vigorously boosting consumption would be the top priority of the economic work for this year. Priority of macroeconomic policies should shift from promoting more investment in the past to promoting both consumption and investment, with more importance attached to consumption.
PBOC Governor there, Pan Gongsheng, speaking earlier here at the Asian Financial Forum. Let's bring in our team to talk us through potential implications of this. Mark Cranfield joins us out of our MLive team, and also our EM macro strategist, Marcus Wong. Mark, I'll start with you, and you've long held the view that markets love to hear Pan Gongsheng. Your initial take?
Yeah, he's in a tough spot, though. In a conference like this, that is a place where he's unlikely to provide any new information, and that's exactly what happened. Everything he just said is a complete rehash of things he's been saying last year anyway, but you wouldn't have expected too much more. There is an important briefing coming tomorrow with the other regulators in China, and if there's going to be any new information, that is where it's going to be delivered. So what he said today is all very interesting, but everyone knows it. There was no surprise there. It is not going to move the needle in terms of improving people's view on China assets and what to do in terms of the yuan, equities or bonds for that matter. They know liquidity is good. They know the PBOC are continuing to do that. What they want are interest rate cuts, and they're not being delivered yet. There's disappointment on that front. Essentially, what the Chinese authorities are trying to do is ask investors to be patient, and that's the one thing they don't want to do. Donald Trump is coming in next week, and we've got the Lunar New Year holidays before the end of the month. People want to see results quickly. They put a lot of money into Chinese equities at the end of last year. September, October, money flooded in. It's gradually trickling out because they're not delivering in terms of what they expect on the economy. Of course, it's going to take a long time. These are very medium to long-term measures. You're not going to see immediate results. But investors are not like that. They want to see things straight away. So you've got a big disconnect here. Hopefully tomorrow, in the briefing, there will be something fresh. There will be something exciting for investors. If not, we're going to struggle probably all the way through to the Lunar Year break.
Marcus, Mark talking a little bit there about some of that disconnect for investors. Tell us, what are investors expecting from the PBOC ahead of Trump's inauguration, ahead of some of those tariffs that we're expecting to roll in, Marcus?
Yep, I think the PBOC obviously has, launched a list of measures. I think most recently, of course, today, they mentioned how they are allowing offshore funds to essentially borrow more overseas. And this is just an add-on to a list of priorities and initiatives that they have launched. But of course, so far, all they have done basically is to defend the yuan ahead of tariffs. And I think there is discussion among analysts out there, essentially, is that if Trump does go ahead with tariffs, and there's a high level of certainty that he'll likely target U.S. tariffs on China first, that the first line of defense essentially will be from the PBOC instead of the government. Of course, you heard measures, from like Vice Finance Minister last week that, China will prioritize more fiscal policies. Again, we heard the same thing from Governor Pan today. But again, these measures have sometimes been a false dawn. As Mark's mentioned earlier, investors are waiting with cautious optimism or sometimes cautious doubt that may happen. So the PBOC will be the first line of defense if and when US imposes tariffs on China, with some analysts even expecting a one-off devaluation in the yuan. Of course, PBOC is very cognizant of the turmoil that they caused in 2015 when the yuan was devalued. So, of course, measures here will be taken with prudence. But, there's, of course, a large sense of the market that the dollar yuan is heading upwards in the coming months ahead.
Mark, I'll bring you back in. We know the pain point. We've been living through the pain point of a stronger dollar, looking across EM and EM assets, Mark. We've started to see it play out in recent days, late last week, when it comes to U.S. equity markets. Your outlook for U.S. equity markets these next few weeks as we try and grapple with yields at 5%, Mark?
I think people are beginning to realize that the headwinds are really building up here for U.S. stocks, just ahead of the earnings season as well, which is pretty interesting. So, as you say, the interest rate factor is a big headwind as well. They're getting used to the fact that yields are going back up now, and as Annabelle was saying, maybe there's even the risk that the Fed has to raise rates later this year. You've already got a very strong dollar. You think about the major companies who drive the US equity market, the so-called Magnificent Seven. They have huge earnings overseas. So if that is being affected by the strength of the US dollar, that is a potential negative when it comes to the earnings season. It'll be very important what they have to say about how exchange rates are affecting their flows in terms of revenues for the year ahead. So that comes into play as well. It's the big banks who start off the earnings season this week. They'll probably do fine. But what people will really care about is the tech sector. If the tech companies give any hint that a strong dollar is really affecting them, that will be another negative for the US equity market. And then you throw in these new sanctions on Russia as well for the oil. Oil prices suddenly are spiking higher. We were expecting Trump's policies to be inflationary anyway, and now we've got oil going back up as well. It's almost like a horrible cocktail. None of it is any good for the equity market.
Bloomberg M-Life strategist Mark Cranfield and EM macro strategist Marcus Wong in Singapore there. Thank you both very much. And still ahead on today's China Show. We're joined exclusively here at the Asian Financial Forum by Yimei Li, the CEO of China AMC, one of the country's largest fund managers.
Yeah, but ahead of that, though, we'll get you an update here on this wildfire and the threats across Southern California. Far from over with forecasts of dry and hot winds over the coming days. We'll get you a live update from LA coming up. Plenty more ahead here. You're watching The China Show. Good morning.
Dry, hot winds are expected to fan wildfires in Southern California in the coming days, promising little relief to thousands of exhausted firefighters. Bloomberg's Laura Curtis joins us now from Los Angeles. Laura, just explain to us, what's the very latest?
Well, we've had a pretty good weekend here in LA. You know, a lot of people have been obviously on edge since these fires started on Wednesday, but we had the biggest fire, the Palisades fire, turned north and was starting to threaten a whole new part of Los Angeles. Friday night. That's been contained actually at that line for now. And so, you know, all day long we heard from officials and firefighters about how much progress has been made and how hard they've been working. And you know, it's definitely an improvement in the mood, I think, but we do have, unfortunately, the next wave of very heavy winds coming, set to arrive tonight and tomorrow, and then really peaking on Tuesday morning. So everybody's sort of braced for that, and we'll see what happens.
Laura, David, I'm going to try and speak over, you know, the volume and the noise here at the forum, but give us a sense, quite literally, what do we know about the direction winds are blowing currently? And I'm looking at some of the headlines coming through, and you know, give us an update whether or not these are still relevant. You know, places like Brentwood and Bel Air could be at risk.
Yeah, so actually we saw a little bit of an improvement for Brentwood today. The evacuation order for at least part of it was downgraded to a warning. So that's a sign that firefighters really think they have that portion of the fire under control. The direction of the wind is really interesting because it's in some ways the most predictable part of this. The winds are a phenomenon called the Santa Ana winds, and they come off from the desert, mostly northeast, from the northeast. So as long as they're, you know, blowing in that predictable direction, we know where the biggest risk is going to be. The other problem, though, is when they pick up. So, you know, to be so strong tomorrow, I think we're expecting a peak gust around 70 miles per hour. That's when it gets very hard to contain the fires because the embers just spread so quickly and to parts of Los Angeles that haven't necessarily been treated with these. I could see you're showing the flame retardant being dropped from a plane right now. You know, a lot of that work has been done this weekend preemptively, and if an ember lands in a place that hasn't been treated yet, then there's really no no way of mitigating that, no way of knowing where that will go. So it's
Laura, thank you so much for the update. Laura Curtis there, our U.S. economy editor, just getting us up to speed on where we are with this. We'll be on top of the story, of course, and give you guys an update once we do have a lot more information these next few hours or so. In the meantime, though, let's send it back to our Hong Kong studios, and Annabelle is there with some headlines coming through. Belle.
Yeah, Dave, some other world news that we're tracking this morning. And Korea's transport ministry says the black boxes pulled from a Jeju flight or jet that crashed in late December stopped recording in the final few moments before impact. A joint team of Korean and US officials is trying to find out why the devices stopped working in the flight's final 4 minutes. The crash killed 179 people in South Korea's worst aviation disaster. Incoming US Vice President J.D. Vance says a deal to release hostages held by Hamas could still be struck before Donald Trump returns to the White House. Vance told Fox News it could happen in the last day or two of the Biden administration. White House Security Advisor Jake Sullivan also told CNN a deal is close, but warned it could still fail. Israel said on the weekend it was sending negotiations to Qatar for fresh talks, and we'll have plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show. We're live here out of the Asian Financial Forum in Hong Kong. A quick glance across the cash markets, and yeah, we're off quite substantially on the Hang Seng Index. As you can see, we're trading below 19,000 for the first time since late September. We're doing slightly better on the onshore markets, but from about a couple of minutes back, we have then retraced down to some of the losses right now. You know what? It's a good day to be shut when it comes to these markets. It's a Fed conversation too, so good on Japan for coming of age day. No cash markets there. A quick glance though at some of the futures trading. Still, you have the contract in Chicago and over in Singapore. The rest of the region, though, like Taiwan, like Korea, and Oz, as you can see, seeing quite substantial losses still.
Yeah, and talking about that story about US exceptionalism, some of that weakness in Asia that we're coming through, as well as, of course, Beijing, where Beijing moves. We have the global co-head of UBS Wealth Management saying that Beijing's more proactive fiscal stance will be as relevant this year to markets, as well as what happens in the US. So Iqbal Khan also told us exclusively that he sees a slower pace of Fed rate cuts affecting investment decisions.
Well, generally, the entire rate curve and everything around rates policy, as well as inflation, has been a key topic and has now reignited again with what we're seeing in terms of the rate curve and what you just mentioned. There was a Bloomberg headline just this morning around scratching 5% in terms of 10-year yields. Having said that, we do still expect a gradual reduction in rates, but we will have to work through in scenarios. Why do I say that? We're waiting for an inauguration. We will see what the U.S. administration will be doing. There are scenarios out there. We need to work through those scenarios. We do believe that there will be continued rate cuts, maybe albeit a bit slower than anticipated, but this is something that we will have to work through.
You just said the Trump inauguration. He's threatened a lot of punitive issues, more protectionist American policy, including tariffs, as well as perhaps more debt issues. The deficit has been a problem in the United States. How do you see that impacting China in particular, which is trying to get some traction in its own economy?
Well, I think if you step back once again and you look at some of the macro challenges in China, we're talking about the real estate sector, we're talking about local government debt, and we're talking about consumer demand. We've started to see a commitment of China towards the economy, and we've started to see that economic policy come to bear. Everybody's, as you mentioned, waiting for March. We will see what the next steps around the more proactive fiscal stance will be in China. That will be as relevant as what the U.S. does.
You think that's what's going to happen in March? Because we've had some false starts, some false dawns, if you will, on the policy front. What would you like to see?
I think we would like to see continuous and sustainable steps towards addressing some of the more macro and fiscal challenges that China faces.
Will 2025 be tougher than 2024, though?
Look, every year, whenever we start a year, there's always this question, will one year be tougher than the other? One of the things that I've learned is don't always follow consensus. That was one of the things we learned when we went to Davos every year. Just think about scenarios, work through scenarios. You will always have additional information. One of the great things about GCC is figure out what is out there. What are the big knowns and what could be potentially the big unknowns, and how are you going to factor that in? Again, one of the key things that we are here to deliver is sustainable performance sustainable impact for our clients. And we do that by making sure that their portfolios, their investment portfolios, are all-weather portfolios. And we work through this with our clients in making sure that they're diversified globally as much as by sector and theme.
Right, it's all about a rate conversation. We're all about central banks today, from the PBOC to the Fed. In fact, coming up on shows, the former Fed Vice Chair, Randal Quarles, will be joining us exclusively. Joining our colleague, of course, Stephen Engel in Shanghai for us. So stay tuned for that interview from the UBS Greater China Conference taking place in Shanghai. Plenty more ahead. You're watching The China Show. Good morning.
I think the Fed's in the refrigerator. They can't cut for, certainly March is off the table.
So this is kind of a Goldilocks type of report in a way. Of course, markets are trading it as a hawkish print. But the reality is that wages are growing at below 4%, even with job gains running this strong.
This is good for the economy. It confirms two things. One is the economy remains solid, and two is the U.S. continues to meaningfully outperform other advanced economies.
Financial conditions are really undermining the Fed's view that their policy is really that tight.
Everything at the moment is probably leaning to upside inflation risks, and it would put the Fed in a really, really tough spot.
Some of our guests reacting to that blowout December US jobs report there. We're here at the AFF Live, but let's go to another big event we're covering live today. We're all over the place, all over Greater China, that is. And our in a good way, in a great way. And our chief North Asia correspondent, Stephen Engel, joining us, of course, from the UBS Greater China Conference in Shanghai. Steve, you're there with our very next guest.
You guys are having way too much fun at the AFF. I should be there. No, I shouldn't. I'm here at the UBS GCC, Greater China Conference. It's the 25th anniversary of this hallmark conference on the shores of the Huangpu River in the central business district of Lujiazui in Shanghai. And our next guest is Randal Quarles, Sinosure Group Chairman and co-founder, also very well known for being the former Fed Vice Chair. You were the Vice Chair of Supervision from 2017 to 2021. Thank you for joining us exclusively here on Bloomberg Television at the GCC of UBS. So they were just talking, and we just heard some guests talk about that blowout jobs numbers Friday in the United States. Obviously, you've been on record as saying that markets have excessively been optimistic that rates would come down. Does this put the pause firmly in the it's going to happen? The Fed's going to pause longer now?
Yeah, I think the jobs number and a variety of other data over the course of the last few months have demonstrated that expectations, including even the expectations that the summary of economic predictions, that the projections that the Fed itself put out at the last FOMC meeting, were excessively optimistic about how quickly the path of policy could come down. It's certainly coming down. It's time for it to come down, but that path is going to be slower, and it's going to stop at a higher rate than people had been expecting just a couple of months ago.
So what would be your best guess, I should say, as far as how many rate cuts would we see this year?
So, the markets have been consistently wrong, overly optimistic for the last 3 years during this whole cycle of inflation and central bank response. But this time, I think they finally may have it right. They're closer to being right than the Fed, I think. Just given where we're likely to see the economy and various other macroeconomic indicators go, where we're likely to see employment over the course of the next year, one rate cut next year is probably closer to right than two, which was what was in the SEP.
How would you assess the incoming policy agenda of President Trump in his second term? It sounds inflationary, tariffs in this part of the world. How inflationary would it be, and how does it impact Fed policy?
So I don't think that tariffs are necessarily, certainly not in and of themselves, inflationary. So they will result in a one-step upward price change, a one-time price change on the goods to which they're applied. But that's kind of once and done, and in and of itself, it doesn't create sort of a continuing inflationary impulse that the Fed would respond to. That's the sort of thing that the Fed ought to simply look through and say, okay, that happened, but there's no need for, there's nothing we can really do about that. There's a possibility that depending on exactly how the tariffs are structured, what goods they end up being applied to, how those goods act as inputs into domestic production within the United States, that could have further expansionary effects if it inflation destabilizing effects, if it affects expectations about inflation more broadly, but that's probably unlikely. In fact, I think it's probably more likely that the effect of that one-time step up in prices could further constrain the economy over the course of the next year or two as it first begins to be processed into the economy, which could actually serve as a reason for the Fed to moderate inflation response further than it might otherwise have. So far from being inflationary and likely to lead to higher interest rates, I think it's actually a factor that would lead at the margin to lower interest rates.
Would you see other parts of his policy platform to have either stimulative or drags on the economy? Mass deportations is one that people have raised to me. How much does that affect the labor market and cause disruptions, et cetera?
Yeah. So, obviously renewing the Tax Cuts and Jobs Act, that's largely been factored in. Some of it was beginning to phase out, and so renewing those provisions will have some stimulative effect. The deportations, I think they're going to be material. But I think just as a matter of the laws of physics and some of the things that Tom Homan, who's the border czar, who's going to be appointed in the new Trump administration, that he has said, focusing on criminals as opposed to, at least in the first instance, very broad deportations. The United States did this 70 years ago in the Eisenhower administration, deported at its peak maybe 1 million people in a year. It's a bigger country, but that project was at the request of Mexico. It had the cooperation of Mexico. It had much broader acceptance in the United States. So I think there will be material deportations, but not something that's going to really affect the labor market in the U.S.
How confident are you that the Fed can maintain its independence, its autonomy under the new Trump administration? Are you seeing signs that it could be in jeopardy?
No, I don't really think that it is in jeopardy. There's a fair bit of misunderstanding about what Fed independence is. Fed independence doesn't mean that the president can't express a view on Fed policy. Presidents over the life of the Fed have frequently done that. They haven't done it, except for Trump, a lot in the last couple of decades. But before that, it was not uncommon. Fed independence lies in the fact that whatever views anyone may have about its policy, the members of the board have long terms. Any single president can appoint a couple of them during any single presidential term. There are the 12 presidents of the reserve banks around the country also participate in those monetary policy decisions. And so structurally, the Fed can't really be affected by the president's bully pulpit. And, the people who are appointed to the Fed generally have fairly thick skins. So while there's certainly political pressure, there's not really political levers that someone can pull to affect their independence. So I don't think that President Trump's desire and practice of expressing views about Fed policy is really undermining the independence of the institution.
You don't think he has the biggest bully pulpit that we've seen in a while?
It's a bully pulpit, but the levers on his desk are not actually attached to anything when it comes to the Fed.
All right. What about Michael Barr stepping down in the position that you used to hold earlier before his term expired? What does that set a precedence? What does it tell you about how the makeup of the governors is right now?
So that post was created in the Dodd-Frank Act after the great financial crisis. Barr and I are the only two people who've ever held it. But it was expressly designed so that financial regulatory policy would be more closely aligned with turnover in the political environment than monetary policy, which, as I said, has these various structural protections. And so I don't think I had not expected that Barr would resign in the way that he did, but I don't think that it's, again, a violation of the norms of the Fed or of democratic norms for the president to expect and for Barr to facilitate that sort of a change. For example, I had a number of regulatory proposals towards the end of my term when it was clear that the Biden administration was coming in, and I said, we're not going to make those. Yeah. Because we could have. I had the authority to propose them. We could have pushed them forward, but I said, it's there's been an election. Elections have consequences. It's the right of the new president to have his way, and it's the right of the new president to have his way.
Lastly, Michelle Bowman is widely regarded as perhaps going to be a successor. What kind of role would she take? And as well, would you ever go back to the Fed if you were asked?
I think that Governor Bowman has done a terrific job as effectively the shadow vice chair during the period of the Biden administration. If Barr stays on the board, then just the way the law works, the president has to pick one of the existing governors. Chris Waller, who's another exceptionally good governor, is a possibility, but Mickey has really had the shadow role and would be a logical candidate.
All right, thanks, Randal, Quarles. Thanks so much for joining us here at the GCC. We didn't even talk about China. You're gonna have to come back and talk to us. I need another 10 or 15 minutes to talk at least about the basics of Chinese monetary policy. Thanks so much for joining us here on Bloomberg Television. Okay, guys, sending it back to you after day one of the UBS GCC here in Shanghai.
Yeah, there we go. A funny story for our viewers. Our first guest here from the AFF was the Pakistan finance minister. And his first question to me and Rebecca was, where is Stephen Engel? There we go, the gravitas of our chief North Asia correspondent there. Right, more on the macro picture and all this volatility in the bond markets is the subject of our big take today. Terminal clients can get that story through the function NI. Big Take is also available online, Bloomberg.com. Plenty more ahead here in shows. We're pivoting back to Chinese markets with China AMC in a couple of minutes. Stay with us. This is The China Show.
And back to our top story today, the PBOC Governor Pan Gongsheng speaking here, reiterating the PBOC's goal in maintaining a reasonable equilibrium for the yuan and saying that the government's top priority now is to promote more consumption. For more, let's bring in our China correspondent, Min Lo. Min, just break down what we've heard and its significance.
Yeah, so the PBOC governor stepping in once again to perhaps stabilize markets as we see this sell-off across both Hong Kong and mainland China markets, but not quite doing enough to really convince investors here. So a couple of things I want to highlight. What he said about the yuan, for example, again, giving more verbal warning that the PBOC is going to provide support for the yuan, that the PBOC's goal is to ensure the yuan's stability. And this comes as the PBOC had increased that macro parameter for cross-border funding from 1.5 to 1.75. What this means essentially is that it allows companies, financial institutions to increase their overseas borrowing. Essentially, it's injecting liquidity into the system. And this comes as the offshore currency is really approaching close to record lows on the back of this dollar strength, this strength in U.S. macroeconomic data. But the PBOC governor reassuring markets that the RMB remains resilient. Have a listen.
Recently, the USD index has remained high, and most non-USD currencies have depreciated. RMB has also depreciated moderately against USD, but overall shows strong resilience. After years of endeavor, China's foreign exchange market has achieved remarkable development. Market participants are more mature, and the trading activities are more rational.
Well, the PBOC governor also gave his assessment of the economy right now, and he acknowledged some of the problems, including the low inflation, low prices, and weak consumer demand. And he said that the government priority right now is to move not just from promoting investment to boosting domestic demand as well. And to that end, he said that the government will be raising fiscal spending to create a more favorable social financing environment, increasing the fiscal deficit expenditure, more counter-cyclical measures, and a more proactive macroeconomic policy as well.
There we go, setting us up for the week, the PBOC governor and the surprise appearance here at the AFF. Eminal, thank you so much for a recap of what the governor just had to say. I would say about, give or take, about an hour back. Now, our next guest is the CEO of one of the largest fund managers in China, joining us exclusively here on set, Yimei Lee, CEO of China Asset Management Company. It's nice to see you always. Good morning.
Good morning.
You were at the audience
yes.
when the PBOC governor suddenly surprised us with his appearance. What was your initial reaction there?
I'm really happy to see him here. And also, well, it's not really surprising to me because I just felt like, well, this is a big event. And his being here really showed the support of the central government of Hong Kong. And also what he said, I think, also reinforced our beliefs and the faith in the resolution of the central government on the, stimulus plan and going forward how to really create a better, future for next year.
It's hard to ignore the backdrop, though, in terms of Chinese equities. It's been a pretty rough start. The CSI 300, HSI, the bear markets that we've seen. What is it going to take to see a sustained momentum in Chinese equities in 2025? And when do you think we might actually get there?
Well, there's always a question of when and where, right? But I think the beginning of this year, people would say a little bit rough, like you said. And it's a battle between the anticipation and the reality, right, as always. And from Governor Pence, I think very clear, speech that the reality definitely will be there, and we are catching up with the anticipation of the whole environment and the market. So I think when and where, there will be a when in the future, especially I think everyone is kind of counting on March, especially after our National Congress, that a lot of things need to go through the procedures. But definitely we have, well, as a Chinese investor, we definitely have great faith and confidence in the next year's equity market.
I want to get an idea of fund flows,
yes.
And you guys provide a very unique window to that. When you look at assets, there was an explosion in turnover right after the PBOC governor's first press briefing.
The September one.
In late September, yeah. Things have remained elevated, but they pulled back a little bit. What are you seeing as far as inflows into your strategies or amongst your strategies?
Well, certainly, I think definitely since the late September, we have seen great risk on, not only just from institutional investors who has already been really holding their grounds, but we have seen great interest from retail investors into the equity market as well. And there definitely have been comes and goes, but I have seen that in early January, when the market has a bit of downturn, a lot of strategic investors also keep flowing into the market to take advantage of the dip in the core assets.
And talk to us a little bit about the timing for Chinese New Year this year. I mean, how is that affecting markets? Does it mean we might see some kind of intervention, perhaps a national team? What are your expectations for market performance through CNY?
Well, I think every Chinese New Year for every year is a bit tricky because there will be a long market close. And this year, like you said, is probably because of the inauguration and everything. But I definitely think that, the government of China and also investors have already anticipating maybe the policy changes already. So it won't be as dramatic as the market probably would anticipate.
how does that affect someone like you who's planning your business? What are your priorities as a business this year?
Well, this year, we have a better outlook for equity, for sure. So we have already positioned ourselves from last year in product development and in client business and etc. to prepare our clients for a better outcome, for a better strategic investment into those pipelines. And also from the fixed income side, I think people are always very keen on investing on fixed income side. It depends on what kind of investors you really are, because in China this is such a vast market. We have so many different investors. So they have short-term investors who have absolute return goal every single year. So we really need to adjust their return goals every single year. So they're very different.
Now, I want to get a sense, just to pick up, since you mentioned fixed income, the bond market has done exceptionally well this year. Do you get a sense that amongst the investor community that fixed income will remain a popular trade?
Well, I definitely think it will be a popular trade, but you probably would worry about directions. It won't be like as bullish as last year, probably, but definitely it will still be popular trade because of our massive savings right now.
And what about your forecast expectations for the AMC business more generally? I mean, what are the obviously there are some challenges. What are the challenges? Are there any opportunities for expansion?
Well, definitely we are always looking for areas for expansion. And today, I think what I interest most about Governor Pen's speech is about how the central government and mainland China is going to really support Hong Kong. And the connect between mainland and Hong Kong will be very exciting this year, with all the connects and also the liberation of some restrictions, and especially about the mutual recognition. And that will really open doors for multi-assets from from Hong Kong into mainland China. And that is just massive opportunities for asset managers in mainland China.
Talk about some of those opportunities. Any plans to expand, hire, build out your offices?
Yeah, we actually doubled our AUM in Hong Kong office last year. And this year we are quite optimistic about our growth in our Hong Kong office as well. So definitely we are looking for talents in Hong Kong.
Well, very quickly, outside of Hong Kong, Latin America, Middle East, anything there, for example?
Yeah, we already team up with Brazil to have a Stock Connect. We are waiting for, not Stock Connect, ETF Connect. We are waiting for the authorities' approval right now. And also we are expanding into Southeast Asia and also including Middle East. So the confidence, once the confidence are coming back, I definitely think more business opportunities.
Excellent. Yimei, thank you so much for joining us. Yimei Li, the CEO of China Asset Management Company. And next, we'll have plenty more from the Asian Financial Forum, speaking exclusively with the Hong Kong Financial Secretary, Christopher Hui. So that's coming up in the next hour. It's a very good morning here at the AFF. Please stay with us. This is Bloomberg.
I'm trying to figure out if I should...
Well, I might just pick up here because we've got markets that are under pressure this morning. We did have the PBOC governor speaking at the AFF this morning. And really the key takeaway from that is that continuing focus on ensuring ample liquidity and also trying to focus on consumption, trying to boost the Chinese consumer. Markets have sort of reacted to that, but it was very much knee-jerk because you're already seeing them giving up a lot of the losses or gains, rather, CSI 300. Fairly steady, Dave, at this point in time.
Okay, yeah, so we're looking at about just over 35 minutes until the mainland markets enter that lunch break. A couple of more, of course, 30 minutes after that, then we do enter the lunch break here in Hong Kong. Plenty more ahead here on Bloomberg TV.